Good afternoon and welcome to a special edition of Nasdaq Trade Talks. I'm your host, Jill Malandrino, global markets reporter at Nasdaq. On the eve of the annual Russell U.S. Index's Reconstitution, FTSE Russell and special guests join me at the Nasdaq MarketSite for a panel discussion on market expectations in advance of the annual rebalance of the Russell U.S. Indexes on June 22nd, examine current trends in the U.S. equity market, and touch on potential investor product and asset allocation strategies going forward. Joining me are Ed Coughlin, who's Director of Trading Services at Nasdaq, Alec Young, Managing Director of Global Markets Research at FTSE Russell, David Mazza, ETF Investment Strategist at Oppenheimer Funds, and Tushar Yadava, he's a Director and Investment Strategist at iShares U.S. Investment Strategy Team. Gentlemen, thank you very much for joining me at MarketSite. We're coming up to one of the most important closing auctions of the year, the Russell rebalance. We're going to kick it off with you, Alec, if you can explain to us why that is such an important day for all investors.
Sure. Well, at FTSE Russell is something we take very seriously. We've got $9 trillion benchmarked to the Russell indices in the U.S. and the Russell 3000 universe. It's about a $30 trillion dollar value in the index. So what we try to do with the annual rebalance is we're really trying to make sure that the indices continue to be reflective and representative of the economy at large. And we feel that a reconstitution and rebalancing once a year allows us to maintain that representative nature that we're looking for, while also trying to keep in mind things like transaction costs and turnover, and trying to keep those to a minimum. So once a year we think works best for everyone.
Well, Ed, let's talk about the mechanics behind the closing cross for the Russell rebalance. That sounds like a massive, massive trade.
Certainly technologically, it's a feat. I mean, if we look at the trades that are happening today, there'll be, if we look at last year, there was about 1 billion shares traded, and those shares transacted in about 1 to 1.5 seconds, and that represented about $30 billion of notional value. And from Nasdaq's perspective, it's all about preparedness, the technology that we have, that supports that type of trading. What we look to do is, it's part of our regular cross scenario where we collect all the orders from participants out there, all the buyers, the sellers, and then at 3:50 in the afternoon, we give indications to the market to tell them kind of what is in our book at that moment in time. And what we hope to have is, by disseminating that information, we gather offsetting orders, new interest in the cross, orders that want to trade. It's a huge liquidity event for traders all around the world that look to this one single day for things to happen.
So from a strategy perspective, David, I want to ask you, how do you prepare yourself for such a massive event leading into the rebalance?
Well, I think so from the perspective of actually managing funds that are seeking to track an index, the goal really is to avoid the potential for slippage. So we'll take advantage of the potential liquidity that actually will occur at the close to try to avoid any potential, again, slippage between the actual funds that we're tracking and the index, because the index itself, of course, is being modified. There are new names coming in. There are names that may be coming out, as maybe if a name is moving from the Russell 2000 to the Russell 1000, or potentially vice versa. So there's a lot of information that needs to be taken advantage of and absorbed before. What's really beneficial to some of the points said earlier is that because of all the technological advances that we can leverage, at the end of the day, the real potential for investor impact can be minimized.
All right, and Cheryl, I'll ask the same question of you as well.
So I think from our point of view, obviously, iShares is a tool and an exposure for a lot of these different markets that are being affected during this. And if we look at it, BlackRock as a whole, I think we're about 2/5 of that number that Alec mentioned earlier. We're a large player in that space. And to today's point, our ultimate goal is towards making sure that the investor experience is true, accurate, and sort of minimizing the effects of it. Because I think the estimates are something like $70 billion net is going to be turning over. That's a huge number. And when you think about it and you distill it into sort of these products, you want to make sure that they're operating on the day the way that they should be.
So as a retail investor, do I have anything to worry about with my funds when this event occurs?
As a retail investor, you've got absolutely nothing to worry about over the long term, because if you're holding these funds over the long term, to the point that Alec made at the very start, right, we're trying to make sure that you're getting the economic exposure that's reflective of sort of the reality of the US market. And so, over the longer period of time, a lot of what you would expect is either sort of ameliorated or maybe less impactful over that longer period. The other thing that I would say is, literally, honestly, the institutional trading power that's being delivered to the retail investor through the ETF is a huge benefit. And if you're an individual ETF or an individual investor, this would be one of the most confusing, difficult days to sort of manage. And what we try to do is do that in a very, very manageable process using massive amounts of technology that I think all the providers here today are sort of standing behind.
Well, with the exception of the funds, are there any way traders can do individual trades on the companies that are coming in and out of the index, or is this just specific to the index itself and the funds?
That might be a better question.
Sure. So every individual component, you know, the Russell 1000, there's 1,000 securities that make that up, you know, minus any attrition that occurred during the year. So every one of those stocks, there will be indications of interest that go out. And there will be people positioning themselves, as Tushar said, that there may be professional investors, long-term investors, as Dave points out, that they're going to take advantage, and maybe they have been a seller in a product and we happen to be added to an index. It's an opportunity for them to have minimize the market impact of their transactions in the market. One thing I would stress, and you talked about the individual investor, and we all look out for the individual investor, is to there isn't. If there's a desire to trade, be smart about how you trade. Put limit orders on your orders. You know, market orders is something, you know, Tushar and I we talk about, that make sure that the price that you want to pay is the price that's on your order.
Right.
And that's one piece of advice I'd give to investors out there.
And that's how institutions trade. It's no different than a retail investor.
Right, absolutely. And the other thing that I would say for, you know, if you're looking to understand sort of how the turnover in individual names is happening and the index as a whole, you know, there are huge, huge impacts, but institutional investors are aware of this. They've been working around it. They've either been sort of lining up their book or they're making sure that they're understood in how they're going to execute it. It's very, very difficult to sort of move out of the way of macro as well in a lot of these days.
Right.
So, you know, you could have some exogenous event or just some event that is changing the direction of the market and affects that trading in a similar or larger amount as well. So it's not an easy game to play just by looking at the numbers and saying this amount has to trade on this certain day.
Yeah, I mean, one other thing I think retail investors can look at is the tracking error on their products. And they'll find that for a lot of these passive products that are tracking things like the Russell 2000 or the Russell 1 or Russell 1 Growth, Russell 1 Value, et cetera, the tracking errors are extremely low from the leading providers, some of which are on the stage with us. So I think that's an indication that these firms are managing the reconstitutions very effectively. If they weren't, you'd see much wider tracking error.
Right.
It's a great point. The other thing I'd add to this is, especially when it comes to ETFs as the tool, and I think you're alluding to this, they can be really beneficial for retail and institutions actually to help manage these events. Because to your point, if you were trying to do this on your own, if you were trying to build a diversified portfolio as an individual or even to some extent as an institution, unless you have the capital to do so, it can be very difficult, especially managing around an event like this. So the ETF, which is seeking to track that index, is going to effectively do that turnover for you and do it in a low-cost, really transparent way. So you can own the ETF into the event and end up with a new portfolio that's going to be reflective of what the new universe of small-cap securities or large-cap would look like.
And that was my question to you. How do you determine what goes into which index?
Right. Well, there's a lot of rules around, you know, what constitutes, you know, a small cap, a mid cap, a large cap. One trend we've seen with the bull market that we've been enjoying over the last decade is that everything has gone up in size. So a small cap today is much bigger than it was a few years ago. Based on the current breakdowns, and I'll use approximate numbers here, but it used to be that if a company was $3.5 billion in market cap, it was solidly in the mid cap territory on its way to large cap. Today, that company would still be in the small cap universe. So, you know, just it gives you a sense of the inflation that we've seen. Small caps are now bigger because the small cap space has rallied so much. Mid caps are bigger, large caps are bigger. You know, we've really seen, you know, the cap sizes kind of move up. But in terms of, you know, exactly where those lines are drawn, it really becomes a very quantitative process that we have a lot of people working on. And we also have buffers on either side of large cap, mid cap, small cap to avoid, again, you know, excessive turnover that can increase cost and reduce efficiency for the end investor.
All right, let's talk some macro here now that we understand what the closing cross and the Russell rebalance is all about. There is certainly no shortage of news in this market, and there are several key factors that are driving the market, particularly the small cap index, with the dollar being where it is, and tariffs and so forth, as we were discussing earlier. But let's kind of go down the line here. What are you hearing from clients? What are you hearing internally that is concerning for your business, and what catalysts potentially are there?
Yeah, it's a very prescient time, actually, because we're just about going through how we're going to think about our outlook for the next year. And the majority of the meetings I cover the global institute or the U.S. institutional channel. So it's large players in the market predominantly. And so when I'm talking with them about their investment strategy, their market outlook, the overwhelming thing that comes up a lot of the time is just thinking about 2019 problems. And really, we're not that far away at this point in time. And the discount period that you would start to think about what the impact is of these stocks is getting shorter and shorter. And you know, the variables, the macro variables, where is growth pricing at the moment? We're actually quite positive still on growth at the moment, especially in the US. Whereas inflation is going to affect your multiple over that period of time. What's the impact of buybacks, right? We have this huge impact from tax reform that's being seen in the buyback market over this period of time. So a lot of investors at the moment are really just trying to chew over this idea of how we think about what 2019 is going to start looking like, because we've been through this huge extended bull run at the moment. Does it still continue? And you know, is the outlook still healthy? And from our point of view at the moment, the answer is still absolutely yes. It's just the exogenous shocks that we're starting to look at, like trade, like tariffs, and maybe the shift in regime, which really starts to affect some of those other factors like the multiple or earnings trajectories.
Yeah, it really feels like that this is a global chain of dominoes, if you will, and you're starting to see that trickle-down effect for sure.
Yeah, no, I would agree with that. I think from a background for economic point of view, it's generally still healthy, generally still constructive. The challenge is that when you're on the cusp, or maybe actually already have entered this time of regime shift, especially driven by what's happening, of course, in the rates market with the yield curve, you're now starting to see volatility come back into all markets. You're starting to see correlations potentially pick up in certain areas and beginning to see real differentiation in returns. 2017 was a bit of an anomaly because it was so terrific. And on one hand, we love a market like that, right? Because everything's going up. It was frankly somewhat easy to make money. 2018, of course, has not been that case. And really heading into the year, many people, I think, were still expecting large caps in particular to kind of continue to be the driver. But we've begun to see small caps actually begin to rally significantly, and the spread between small and large increase. And I think there's some good reasons for that. But that's kind of one of the reasons we've been getting investor questions, because traditionally you see that actually coincide with value stocks doing quite well as well. Small cap and value tend to have a correlation. Hasn't really necessarily been the case. So again, we're seeing this dispersion happen, which actually could be healthy for people looking to implement ideas in their portfolio that they were kind of sitting on the sidelines because everything was just going in one way.
All right, and would you agree that we're getting really close to that 2018 end line and we have to start preparing for 2019?
Yeah, I mean, the markets are always a forward discounting mechanism, so they're really always looking out 9 to 12 months. So you're kind of always in that process. But I mean, I think some great points have been made. I might add that, you know, it's nice to have the optionality within the Russell 3000 universe of that large, small growth value, because we're really seeing very pronounced leadership. You know, the small caps, as has been mentioned, is leading, and in terms of why, you know, we've done a little bit of work on the revenue breakdown of the Russell 2000 small cap index versus its large cap counterpart, the Russell 1000. And a lot of the outperformance stems from the fact that the Russell 2 is only 20% of the revenues come from overseas. The Russell 1, the number's in the low 30s. And so when we have any exogenous international negative headline, whether it be trade lately, also we've had some geopolitical, we've had earnings drag from a stronger dollar in the last couple of months, all of these things have helped the Russell 2000 outperform. Any day where you see trade in the headlines, look at your phone, you'll more than likely see the Russell doing better. And all these things have actually added up to over 600 basis points of year-to-date outperformance of the Russell 2 versus Russell 1. So I think that's one thing that we're definitely seeing in this sort of dichotomy between domestic versus international. The other thing we're seeing is, I think, a secular shift towards, you know, things are changing so much faster, technology, everything seems to be up and to the right, as Thomas Friedman has written about. And so to the growth value question, it just seems to augur to the benefit of growth. And we're just seeing overwhelmingly, whether it be technology sector, healthcare, consumer discretionary, just endless leadership across the cap scale.
Right.
And you know, you never, I'm not in the market forecasting business, and you never want to say never, but especially when you think about the yield curve challenges for financials, and obviously the volatility in the energy patch, it's really hard to envision now what causes the next secular bull market in value over growth. And maybe that's when it changes, is when everyone sort of throws in the towel. But we're seeing, I can't remember a time when we had so much size and style, pronounced leadership. Small over large, you know, growth over value. And again, that's not a forecast. That's more just an analysis of what we've seen to date.
All right, and from the trading perspective, what are you hearing?
Well, what I look at is kind of from the exchange. Our number one mandate is kind of to create an environment of investor protections and safety of trading so that when people enter their orders, they know they're getting the price, whether it be on screen or that there has some safety mechanisms behind it. And Nasdaq's going through a big effort with Project Revitalize, where we have emphasized that there is just a lack of companies going public than what there was. There's about half the number of companies that are public today than there were 10 years ago, 15 years ago. And we look at Mr. and Mrs. 401k. We want them to participate in wealth growth in America. And Nasdaq has undertaken this initiative to promote the public company. We've taken initiative from a market structure perspective. Maybe one size doesn't fit all from a market structure perspective. From a regulation perspective, maybe one size doesn't fit all. So we look at tailoring different ways to ensure the safety of trading. We look at ways to promote public companies, potentially over private. When you look at, and while there's nothing wrong with venture and there's nothing wrong with private equity, but Mr. and Mrs. 401k want to contribute there. And I guess I'd lastly leave it with variety, this big trade, and that we look at how do we make sure that trading is as orderly as possible, that it's within the realm of what people expect to occur, because there's going to be some very big trading. And it's a big day for us, and we're looking forward to it.
Well, it goes back to what you're saying about Revitalize, about confidence in the markets.
Yeah.
That trade does have to execute
Absolutely.
perfectly for that reason.
I want it to be a boring day. There's going to be a billion shares trade, and it's going to be about a second and a half, and everybody's going to clap.
It literally takes place in...
Literally a second and a half, a billion shares, $30 billion of notional value. I would say maybe I'm the elder statesman in the room here, and I remember when seconds were fast, and we're now down to trading in microseconds, nanoseconds, and it's terrific.
So what's it like? Is it like an all hands on deck situation? I'm just trying to envision it in my head. A bunch of traders on a desk in 1 second, it's done.
Well, so we're kind of the governors or the overseers and make sure that there's no problems. I hope my day's boring. The trade desks are out there really active. One important note is that while we release the last-minute imbalance information at 3:50 in the afternoon, and the other exchanges also have mechanisms to tell what the imbalances are, people have been getting ready for this for weeks. So it's not like somebody says, I have 10 million shares to buy, and I have 10 minutes to find a seller for 10 million shares. It doesn't work that way. So I want to reassure people that the firms out there are well prepared in advance. And sure, there's a few surprises on that day, and that's why we have eyeballs and people that are ready to trade against those situations, provide liquidity. There's lots of really good market makers that supply liquidity in the market.
Yeah.
But it's an exciting day. It's, in 10 years, are we going to see 2 billion on that day? I don't know. I'll leave that to you guys. But certainly the growth in AUM in the asset management industry has been fabulous. We love being partners with, all of the firms out there.
Yeah. So you guys have had short-term strategies in place going into this.
Yeah, I think every year, obviously, every year it's a little bit different in how you approach it with the respective adds and deletes. And, like I said, the macro picture as well is always big. But, it's not something that you sit there and, suddenly at the end of the day, you're like, jamming all these orders in, and it's, like trading places, it's a bit more Superman 3, where like all these massive computers are around and sort of, we've worked it out, we've figured out who our partners are going to be on the day, and, we have a good idea of how that flow is going to sort of be executed. So it's well planned in advance.
Well, let's talk about longer-term strategies, particularly passive versus active. That's been such a huge debate, particularly in your spaces. I know I've been covering it for a better part of a couple of years. How does this sort of fit into that, particularly with volatility picking up? Clearly, headlines are driving the markets right now. It seems as if active is swinging back in favor a bit for those reasons.
I'd say broadly from a portfolio construction perspective, it's likely a role for both in a portfolio, depending upon what your outcome is seeking as an investor. But what we've seen is as passive strategies has grown across the spectrum, really it was just kind of a large cap phenomenon up until not too recently. But now you can get access to a multitude of different strategies, whether or not it's ETF form or mutual fund, index-based mutual funds, to allow investors to, in a low-cost, transparent, tax-efficient way, construct diversified portfolios. But again, for investors who are looking to be able to find good managers or do more than you're getting with benchmark, still a role for active to play in a variety of different areas. And many would point to small cap securities in the U.S. being a prime space where we're a select managers who have the insights and have the firepower to identify those securities that can do well, actually would be a great role to add some active and passive together, again, to meet a particular outcome that you have as an investor.
I think I'd piggyback on that point on active working in less efficient markets. So I think international small cap is another area.
Great example.
And the global stage generally, where I know Oppenheimer Funds plays in a big way. But I think even within that, international small cap seems like an area, regardless of active passive, although it does seem to lend itself a little more to active. But I think Americans are generally underexposed. Most of their international exposure is going to be, a large cap, Europe, Japan type of product. They need to remember that within that there's an entire small cap universe. They see what's happening with the Russell 2000 in the U.S. There's actually, I think that's a global phenomenon of small cap leadership. It's not just happening here. I'm not as familiar with all the stats, but I'm pretty sure year to date, small cap is. So that's a bit of a blind spot in a lot of people's portfolios. A little less correlation. It's something that can get that diversification that everyone's looking for. So regardless of whether you go active or passive, we're agnostic at FTSE Russell from that perspective.
Exactly.
We welcome our partnerships with firms across the spectrum in both capacities. But I would generally agree that there's been too much black and white with active passive.
Right.
The reality is gray. Most people use both, and I would endorse that.
Let's just leg out your example a little bit. You're talking about international small cap, which in and of itself is a pretty active decision if you're going to go out that far. Yeah. And if you're doing it with a passive vehicle, an ETF or an index fund, it's still a pretty active decision. And asset allocation is, by and large, mostly an active decision. Now, the very pure active that a lot of people like to focus on or maybe belabor, look, to Dave's point, they're always going to have a place in the portfolio. If you can deliver 1% alpha year over year, information ratio above 50, good God, like everyone will be giving you money, right? The trouble is not a lot of people have, and passive's done what it's supposed to do over that period of time. I think volatility is obviously going to help, dispersion's obviously going to help, but every year through this bull market, we've had dispersion, right? If you look at just this year's winners and losers, right? Home builders are among the losers this year. Energy among all the sort of energy subspector are all along the winners. And last year it was the absolute reverse of that. And there's about 40% difference between those two subsectors. And so that persists year over year over year. Stock selection, even in the S&P 500, which is the most covered, index on the planet, and the stocks are the most covered out there, you can still make a lot of money that way. And so, active, if it's doing its job, it's always going to have a place in a portfolio. But any decision that you're making, international small cap, US small cap, whether I tilt here or tilt there using a passive product or an active product, it's still a pretty active decision. And, I think that's the important part of the investment process that people overlook in this debate.
Right, and I thought it was great what you had said, that everyone operates in a gray environment. Yeah. It's almost impossible to be exactly one way or the other. And you almost wonder, how did we become so polarized?
Well, I don't know where the sort of tablets from Mount Sinai came down with the asset allocation and said everything beyond that is an active decision. But I feel like you're stepping into that realm whenever you're making that decision as an investor.
All right. Well, I think we've covered plenty today, from a second and a half to long-term investing, passive, active, and how FTSE Russell sort of makes this all happen. And so we're looking forward to Friday, June 22nd, one of the most important auctions of the trading year. Thank you, gentlemen, for joining me at MarketSite. And traders and investors, thank you for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.